Good morning. I'm Tim Nyland, and today we're going to review the results of the Q3 2021 rebalance for the earnings certain family of equity model portfolios, along with the equity select lists that feed into the family. I'm also going to share general thoughts, comments, and questions I've received over the recent weeks. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you'd like to do the kind of analysis you're going to see in this video, then you need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor tools and the Zacks Research System. Let's go ahead and get started. Up on the screen, I've got the price and earnings chart set to a 20-year time frame for the Zacks Earnings Certain portfolio. This is the core 75 stock portfolio, and you'll note that it looks the same. Right? It pretty much looks the same as it did a year ago and the year before that. And that's actually a good thing. Recall that the idea here is to construct a 75 stock portfolio where we know where earnings are going to be 1 year forward with upwards of 95+% certainty. And the objective here is to obviously remove the variability in earnings away from the S&P 500. And along with that, the volatility. So what I've done, just as kind of a quick recap here, is put the S&P 500 composite up on the screen and just remind everyone, the orange line up here is your trailing 4 quarters adjusted earnings, and the blue line is price. And you'll note that when I toggle between the earnings certain portfolio and the S&P 500, it's almost as if you just literally stretch the lines. They become flatter, which means less volatility, and it obviously provides that type of protection for your portfolio on the downside because of the fact that the underlying corporate earnings remain so stable. So what I want to do is just remind everyone this quarter why we do things the way we do things, because this is another quarter where we don't have any changes to the underlying earnings certain portfolio family. And that's actually a really good thing. It keeps our turnover low, keeps the conviction high. CH Robinson is the only company that remains on watch, and we'll review that here in just a minute. One of the things that I wanted to talk a little bit more about is some of the questions I've had about being able to trade within the portfolio. And it's interesting because these questions all seem to happen roughly at the same time. Within the past several weeks, there's been a lot of jitters about the possibility of there being a market correction. And I've had many, many calls regarding, what we're going to do in anticipation of a market correction. And the idea is with the earnings certain family of portfolios, we do nothing. And obviously you have the ability to put option overlay strategies in if you'd like. You can sell covered calls, generate additional income if you so desire. But the idea here, if you look at this portfolio, is, and you do recall that we end up picking up alpha during downturns, especially the sizable ones, is that this portfolio, you can tell by looking at it, it doesn't care if we have recessions, right? It doesn't care if growth is outperforming value or value is outperforming growth, right? It just doesn't care. The only thing that impacts the PE multiple in terms of its expansion and contraction is what the anticipated changes in equity risk premium are going to be over the next 1 to 3 to 5 years. And the reason for that is that we have, again, removed that guesswork involved in trying to determine where earnings are going to be 1 year forward. Recall that the variability in the S&P 500, at least a lot of it, okay, in terms of its price volatility, is due to the fact that we have an entire market that's trying to determine exactly where these earnings are going to be 1 year forward. And that's what leads to all this price volatility. So as you would imagine, if we remove that earnings variability component, and we know that 1 year from now, earnings are going to come in here. Remember, we have earnings lagged by 1 year. So if I take that off, okay, earnings are going to be here with basically, roughly 95% certainty 1 year forward. Then the only thing that can really move the earnings certain portfolio in terms of a PE multiple expansion and contraction is going to be that component called equity risk premium. And that is exactly why we use the earnings certain portfolio to calculate equity risk premium, because this represents a really, really good market basket of equity securities where we can eliminate where earnings are going to be 1 year forward as a factor, right? We know where they're going to be. We can anchor that point and we can solve for that movement or that change in equity risk premium that basically sets this valuation model that we have into equilibrium. And that's basically what I do every week. So let's remember that when we talk to clients and we're trying to figure out, what we're going to do to prepare for any sort of a market sell-off. Remember that we capture alpha, sizable alpha in some cases, during market sell-off. So the earnings certain family of portfolios is built for exactly that. Had some additional questions that were interesting around trading rules, specifically around companies like Clorox. And remember that I've said for quite some time that I'm not a huge fan of diversification across emerging markets and diversification across Europe, specifically because in the earnings certain family of portfolios, you've got the bulk of these companies are multinational. So you're already getting that diversification component inherent, and you're not even really exposed to the currency risk directly because the companies manage that very well, especially at this level. In the case of Clorox, the interesting thing to note here is if you pull the valuation model up, right, the question was, hey, shouldn't we have sold Clorox up here at the top? Well, I mean, perhaps, and hindsight is always 20/20, but isn't the fact that, Clorox rising here and the fact that Clorox has always been a member of the earnings certain family of equity model portfolios, this is what it's designed for, right? So while Starbucks, which is also a member, and other companies, were selling off during the COVID crisis, Clorox was providing that necessary diversification component to keep those price returns elevated through that crisis. Okay, we didn't know it was going to happen. So if we go and try to trade Clorox, who's to say we're not going to have another variant come up? And if you're going to use some sort of trade timing tool, who's to say that your trade timing tool is going to be accurate? And then when do you get back into Clorox? Okay. So the idea is, do we want to trade around individual holdings within the earnings certain family? And the question to that, or the answer to that, is obviously no. And the reason for that, again, is that with all asset classes being so heavily correlated, or I should say highly correlated nowadays, you actually get some really amazing diversification benefits within the earnings certain family of equity models. And you're going to see that here in just a minute. When I show you what's happened with Clorox, right here, it did exactly what it was supposed to do. And while all the other companies are recovering and Clorox is normalizing back out, okay, it's once again doing what it's supposed to be doing. And what exactly do I mean by that? Well, if you run a 20-year least squares trend on earnings growth, you'll see that Clorox has grown at roughly 6.6% over the past 20 years, at least their earnings, okay? And isn't it interesting to note that in 2022, we're going to actually correct down about 29%. Again, this is in the process of normalizing that earnings trajectory back. 2023, we go to 23%, and lo and behold, in FY3, we revert right back to that 20-year trend, okay? So Clorox is doing exactly what it's supposed to be doing in our portfolio. So what I want to encourage everyone to do is try not to evaluate individual members in isolation, as tempting as it might be, right? I do that. I do it every day, and that's part of managing the portfolio. But there's a lot more that goes into the management of the portfolio rather than just trying to look at how we might be able to game a company like Clorox. And we're going to look at a couple others here for as well. So just keep in mind that Clorox has done its job and continues to do its job, and it's going to continue to deliver the portfolio that rock solid 7% forecast earnings growth, and that's what it's on track to do. So opposite to this is a company that I added back in June of 2017, and you will see that as Clorox has basically trended down, Waters has stepped in, and we don't need to save this, and basically brought that more, you could say more or less brought that Clorox loss or that downtrend in price to more or less neutral with its increase in price. So again, individual company like Waters doing exactly what it's supposed to do as part of the family. I added Waters here, right? Obviously has all the characteristics of an earnings certain portfolio member. And the idea is, would your trading tool and would your trading rules have told you to sell Waters here, right? Probably, as we headed into this dip. But Waters did exactly what it was supposed to do during the recession, and that was provide this type of return for us with this type of earnings stability. And you can see we actually pulled earnings growth forward here, and Waters continues to perform for us. So at the same time, Clorox starts trending down, we get companies like Waters in the portfolio that more or less continue that trend. And the idea is we do this enough and you end up with this rock solid trajectory that just keeps on going. And we're going to talk a little bit more about this in a few minutes because I've actually got an updated client presentation PowerPoint deck that I can make available to all viewers on the earnings certain family of equity model portfolios, and you can actually use this to present to your clients. So we're going to go through some of these slides here. I've updated them all through today, so it's a brand new deck that I'm more than happy to share. So all you got to do is just reach out. At the end of the webinar, you'll have my email address. You'll have all the contact information to sales support. You can reach out to anyone and receive a copy of the deck from today. Next stock I want to take a look at is Thermo Fisher. And again, I'm just speaking more in line with these trading tool questions that I've been presented with. And I've been presented with questions around trading and what to do heading into this uncertain time that we always have around this October timeframe. Now, I've probably been asked by 7 to 10 financial advisors what we're doing, and I have this same conversation with them, specifically around trade timing. If you were using trade timing tools, there's a lot of them out there, right? They would have told you to sell Thermo Fisher right in here as these earnings were obviously more or less hitting a cycle peak, if you will. The interesting thing about Thermo Fisher though, is it just continues to climb, okay? And as we've seen again and again this week with Dollar Tree, right? We've been talking about Dollar Tree over the last couple of weeks related to freight and shipping costs, and Dollar Tree was having margin pressures. And I told you all then that the reason why these companies are earning certain members is because their management teams do nothing but manage this earnings line for stability. And we saw that happen again with Dollar Tree as early as this week. Dollar Tree, I don't know if it was this week or maybe it was Friday of last week. I think it was up like 13 or 14% in one day. When management, obviously, I don't know if they were watching my webinar or not, but we called them out on the margin issues they were having. And they've responded in terms of raising their prices above $1, right? We spoke of the fact that revenues are trending down. It didn't look like they were able to pass those cost increase along to their customers, and so their gross margins took a hit. They were able to offset the decline in gross margins by cutting costs in SG&A and R&D. Obviously, they don't have much R&D, so it was primarily selling, general, administrative. They were able to keep their net margins flat. But obviously, with what's going on with shipping and everything else that's going on with inflationary pressures, they've realized now that they've got to raise prices, and so that's what they're doing. The stock shot up some 14%. So there's a lot of different scenarios in the earnings certain family. I know each of these companies like the back of my hand, and I can tell you that all of them do things a little bit differently. And some of the stories I've shared with individual advisors that reach out to me with concerns, I can obviously do that with anyone that calls me. But think of it like this, right? If you're not like Dollar Tree and you're not managing the bottom line that way, think of a company like ADP, right? That's a conglomerate that likes to keep all of their subsidiaries more or less running separately. And the interesting thing is that you'll notice companies like this, 10%, 11, 10%. I mean, ADP has literally grown like this ever since I've been managing this portfolio. This has been going on for 20, 25 plus years, okay? Anytime one of their divisions step out of line, they're on the chopping block. right? So you're either contributing to this, or if you're taking away from it, you're going to get sold off. And that is what we call a roll-up, and that is what ADP is famous for. So there's all sorts of these different scenarios embedded within the earnings certain portfolio. So it's just a matter of understanding what each of these companies do, what their business model is, to determine what their contribution is to the entire earnings certain portfolio. So when I manage the earnings certain portfolio, I'm looking at the portfolio in aggregate, but obviously there are a myriad of characteristics that I look at that roll up to the larger portfolio itself. So what I wanted to do now is take a quick look at the document that I submit internally for changes to the equity select list and the model portfolios, and just talk briefly about some of the changes. So basically what happened this quarter is that we've got a lot of transitions still underway, right? We've had the Delta virus emerge. We've had growth basically get postponed. We had value stocks take a pause. We had the resurgence of growth stocks off the back of Delta. Now we've got the Federal Reserve responding to inflation a bit early. They're moving forward with actually moving up the schedule for the reduction in the asset purchases. And so I'm holding the equity select list and model portfolios steady at this point. Like I said, I've got one stock still on watch, and that's CH Robinson. We'll look at that here in just a second. And I've only had a couple changes here. In the standard industrial portfolio, Bath and Body Works replaced L Brands after they spun off Victoria's Secret. And Volkswagen Group is going to replace Navistar. And Navistar was obviously acquired by the Traton Group, and they're actually a subsidiary of Volkswagen. So if you can imagine the standard industrial portfolio, this is where I do a lot of my strategy work. Everybody has seen my webinars on this. I'll go ahead and lag the earnings 1 year. We split this into two equal portfolios, 200 cyclical names, 200 growth names. Both changes this quarter happened in the cyclical portfolio. And the biggest one is obviously going to be the removal of Navistar and the addition of Volkswagen Group, right? And Volkswagen Group is obviously an ADR, and VWAGY. And you can see they obviously do a lot of business here in the United States. They're not going to be a member of the S&P 500 because they're an ADR, but isn't this a great addition to have to a cyclical portfolio to basically understand what's going on with cyclical type earnings as a group? You're not going to have this in the S&P 500. You get it in the standard industrial portfolio. So I want to take just a minute and mention to everyone that you should have received an email from us that outlines these changes that look similar to this. If you haven't received that email, please reach out to us. Obviously, check your spam filter if it's not in there and you're an ECP subscriber. Please reach out to us and we'll get your email on the list. The other thing I wanted to mention briefly here is that within Advisor Tools, I've got Advisor Tools, the quote monitor specifically. If you click on this tab here, at the very bottom, so you bring your, actually, I don't even think you have to do that. I think it's just static here on the bottom. You can see the news, watch list, and alerts area. If you click on this options, you can go to create, edit, model portfolio alerts, and you can see that I have a stocks, enters, or exit Zacks equity select list, and I have stocks, enters, or exit Zacks equity model portfolio. So if you just check both of these are your macro portfolio alerts. Then anytime there's a change to any of the equity select list once a quarter or the equity model portfolios, they will appear here in your alerts window. So it's really nice to have that visible, at all times down at the bottom. So you can suppress it by clicking this arrow, and then you can bring it up by clicking this arrow here. So it just toggles. And again, just to refresh everyone, the equity select lists are going to be the standard industrial portfolio, the cyclical portfolio, the growth portfolio, and then keep in mind that it's the 75 most earnings stable companies out of the growth portfolio that then begin to form the earnings certain family. So you've got your alerts that you can set differently for these three portfolios versus these four portfolios. And that, again, is represented right here beneath options, create, edit, model portfolio alerts, these two options. Here's your select list again. Here's your equity model portfolios. So everything is there for you. Okay. As I mentioned, C.H. Robinson remains on watch. A lot of reasons for this. Obviously, C.H. Robinson, one of the world's largest logistics, transportation types companies, having a little bit of a rough go here as of late. We're not going to give up on C.H. Robinson. There's many reasons for this. One of the things that I'm keeping my eye on is the reinvestment that they're making in the business, and you can see what it's doing to their free cash return on invested capital. And I want to see some improvements into this pretty quickly. I've got this relative to Noble right now. I apologize. I was doing some work earlier. I'll make it relative to the S&P 500. And you can see the SP5 is now ticking in at about 5 times better than C.H. Robinson, but that hasn't been trend, right? C.H. Robinson's always been a top performer. You can see that along the lines of like an Expeditors who's in the same line of business, who has a much different capital structure, who's actually faring much better, clicking in at about 23.55. This is basically one of my preferred capital efficiency ratios. And again, it's the ability to compound that free cash flow on invested capital. And Expeditors is just top notch. And they're also a member of the Earnings Certain family. And you can see Expeditors actually looks very similar to Thermo Fisher. A lot of people would have given up on Expeditors here if they had those trading rules in place. You probably would have missed this entire run up just given the taper of this earnings that's been forecast. So it's really, really hard to read these earnings certain stocks from time to time. People will pay a premium for the stability and quality of these earnings, and Expeditors is certainly world class. Okay, so I look at Expeditors. When I think C.H. Robinson, I'm always looking at Expeditors as well. Again, a little bit different capital structure, but two just best of breed businesses. So C.H. Robinson is the only company that remains on watch, that is on watch at this point. I did want to address Facebook. I've had a lot of questions on Facebook, and this one is super important to me, as it should be to everyone. It is one of our 6 macro tilts for the Earnings Certain portfolio, and it's been on everyone's mind over the last couple of days. And to be honest with you, it's been on my mind ever since it went public. And it's been a part of my personal portfolios ever since it's gone public, and it's actually been a member of the ECP macro tilt ever since it went public. And the reason for that is just the size, scale, the mode. I mean, it's got everything in place for what it takes to be a multi-bagger. If anybody attended Meyer Thacker's webinar last Friday, you heard all about those criteria, and Facebook literally fit all of those right out of the gate when they went public. Okay. The idea here is that what Facebook is facing now, I mean, are they going to be subject to regulation? They've always been subject to regulation. Does this whistleblower make anything, make matters worse for them? Perhaps. Okay, perhaps. But it's still not going to change the fact that they've got just shy of 3 billion users on the platform. And there's always going to be regulation and always going to be changes to Facebook's business. But the fact that, as we saw yesterday, and again, I think that was, Monday actually, when Facebook had their outage, that, the entire world just couldn't reach each other and advertisers couldn't meet their clients, and it really showed the importance of Facebook. From our perspective, right, we don't want to lose sight of the contribution that Facebook makes in terms of EPS stability and growth, and we also don't want to lose sight of the capital efficiency ratios, which we'll look at in just a minute. But what I wanted to show everyone is, if you look at the valuation history, just look at a PEF 12M, and you're going to see, right now I've got this relative to the S&P 500, but Facebook has never been this cheap relative to the S&P 500. And that's really not the important point here. The important point is that ever since Facebook has gone public, they have been subject to a lot of criticism, okay? And therefore, the stock just keeps getting cheaper and cheaper and cheaper and cheaper. Every single year, the PE multiple just collapses on growth that's absolutely spectacular. And you can see right now over this time frame, right, the median is to trade at a 59% premium over the S&P 500. I can show you what it looks like. I can just do a right mouse click and draw a trend line in here. I don't know why I didn't do that. Median. How's that? You can see 1.59. Oh, and by the way, I am doing this part of the webinar live. I will be switching over to a PowerPoint slide deck here in just a minute that I will be able to share with everyone, but this part is actually done live, so I apologize for not making that statement earlier. Okay, so you can see the median here over its lifetime is a 59% premium. We're literally now trading at just a 1% premium. So the idea is the low is 0.99, the high is 6.34. So we're literally sitting at all-time low levels of PEF12M. So the idea is with Facebook at parity to the S&P 500, what are you paying for? Well, you're paying for 15% and 17% growth versus for the S&P 500, 9% and 11%. So you're getting 50% better growth and a lot less seasonality and cyclicality with Facebook, right? And obviously they're a massive, massive contributor to our capital efficiency ratios. So let's look at those right now. Return on assets, right? When we start looking at return on assets, and again, I like return on assets. I was trying to think of a better way to explain return on assets to everyone. I think I've got it. When you look at invested capital, right, I always said that the reason I like return on assets, it allows you to really take a look at and compare capital efficiency ratios across sectors between companies. And the reason it allows you to do that is because what you're really looking at is a proxy for all invested capital, including retained earnings, the whole 9 yards, right? Because remember, assets equals liability plus capital. So you can use assets as a proxy for invested capital. So here's your return on assets. And you can see that it's literally close to 5 times that of the S&P 500, right? I mean, this company just absolutely compounds capital on its asset base, okay? Return on equity, still about 4% better, trending with the S&P 500. Return on capital, when you start taking into account debt, right? Facebook's about 2.5 times better. And when we start taking a look at free cash flow, it's about 2.5 times better as well. Okay, so just a great contributor overall. When we start looking at the tilts overall, this is where things just get incredible. Right? You start looking at return on assets. I mean, this group just absolutely out accelerating the S&P 500 on average. Return on assets, this is our 6 macro tilts. This is obviously through today. We're looking at basically 5 times more efficient at compounding capital on their asset base. Again, these are those capital efficiency ratios. This is what Warren Buffett, Charlie Munger, this is what you want to look at for long-term type investments. These are going to be your winners when you can get these types of numbers compounding in excess of the broader market for this many years on end, not just a quarter or two anomaly, but this many years on end. Return on equity, yeah, the S&P 500 has been accelerating, but the 6 macro tilts have just absolutely buried it, okay? And when we start looking at return on capital, start taking into account the debt, you're almost 3 times. And forget about it, free cash flow. The interesting thing I want to point out is that when we start taking a look at free cash flow return on investment, this is probably one of my favorite metrics for capital efficiency. And I know it's probably Warren Buffett's, one of Warren Buffett's as well. He's a huge free cash flow guy. And when you see the S&P 500 just moving in the wrong direction and you continue to see the earnings certain family, especially the macro tilts going in the right direction, this is when you know you're on the right direction. And again, here, you've got a lot of companies in the S&P 500 that are having to reinvest a lot in terms of net property, plant, and equipment, which in terms of, speaks in terms of capital expenditures. And you just don't have that need right here as much. And you can see that free cash flow return on invested capital is just that much better, continuing to grow. And you can see that for the S&P 500, it's just not there. And the interesting thing I want to mention here is that when we look at the earnings certain portfolio, right, it's doing the same thing, okay? The earnings certain portfolio is just able to generate 70% more free cash flow on their invested capital than the average stock in the S&P 500. The S&P 500 has been literally moving the wrong direction. Companies having to reinvest, CapEx just going through the roof, retooling, not the earnings certain family and not the macro tilts. Okay. Note here, this is the earnings certain family. This is the tilt portfolio. I'm just going to put the T up here, hit go. Right? This is going in the right direction, has been since 2018. Okay. This is going in the wrong direction. Okay. That's the tilts. We look at the earnings certain core, really going in the wrong direction for the average company in the S&P, earnings certain 75 stock core going in the right direction. Okay. These are things that we got to keep our eyes on in terms of a portfolio perspective. Okay. So anyway, not concerned with Facebook, especially longer term. Yeah, are we going to face some short-term gyrations and some jitters? Absolutely. But when you're holding stocks for as long as we hold stocks, you're going to face some drawdowns on individual names. Just realize that those drawdowns are met with increases in other companies. And as a portfolio, we continue to compound our profitability and capital efficiency ratios, and we continue to generate alpha. Okay, so we want to focus on this at the portfolio level, not necessarily at the individual security level. So let's go ahead and wrap up this portion of the discussion with just a quick look at the 10-year, or I should say the 20-year, price and earnings chart for the tilts in aggregate. And I just want you to see this acceleration. We go from 49%, we take a little bit of a pause in 2022, which is largely why this group has been sitting flat. So much of that growth was pulled forward during COVID that we're normalizing out. And then we're going to reaccelerate, forecast to reaccelerate back in 2023, right? So I'm not concerned with this group, okay? Not concerned with this group at all. Amazon's been sitting now for close to 9 months or a year, and Apple hasn't done much either. We've got a lot of great prospects here for these 6 stocks. So at any rate, what I wanted to do is show everyone the new deck that I can make available to anyone who requests it. This would be for advisor clients. Even if you're not a client, you're welcome to request the deck. I'd be more than happy to make this available to you. I'm going to walk through it very quickly. It is only about 20 slides, but it goes super quick. And what it does as a financial advisor, it allows you to articulate this story to your clients, right? This is a strategy that you can own, that you can easily manage, and this is kind of how you articulate it. So I'm going to go ahead and start the slideshow, and again, this is something that you can request, and we'll be happy to get it over to you. So here's what you're looking at with the S&P 500. Again, when you think of the S&P 500, I want you to think of high price volatility and low EPS stability. And you can see that here, the variability in the orange line earnings and the variability of the blue line, which is price, okay? The earnings certain core 75 stock portfolio is just the opposite. It's low volatility, high EPS stability, okay? And you can see that here. Earnings certain core 30 Admiral, low volatility, high EPS stability. And you know what? I apologize. I actually have, it looks like a 15-year chart in here. When you request this, I'm actually going to bring it all the way out to 20 years for you. So I do apologize. I just now noticed that sometimes the best way to proofread things is actually to present them, I guess. But at any rate, I will fix that. This is the actual S&P 500 Dividend Aristocrats composite. So again, you can see that high volatility, low EPS stability. This is that really popular ETF by the name of Noble that a lot of advisors like to use for their yield. And you can see that variability here in price and earnings, and our version of it with a 25 stock core dividend portfolio is obviously much, much less volatile and a lot more stability in earnings. Okay, so I go through for you the entire ECP family construction process. I'm not going to go through it again, but you have a slide on that. This particular slide here is basically lifted out of my annual webinar series that I do once a year in the spring, where we make all of our large changes to the recommended macro tilt. And so this, you've seen this slide before, but I want you to think of this slide a little bit differently now that many of you have faced this potential sell-off here over the last couple of weeks, a little bit differently with the ECP and not really having the confidence to take the portfolio through one of these periods of instability. I want everybody to focus on this down market excess return that the core 75 stock has, the core 75 stock portfolio. It's the same for the dividend portfolio, and it's more or less the same for the Admiral. And we have all of those webinars and these decks available. I can send any of them to you. But this was basically actual performance for the prior 180 months. Out of the 180 months, we had 57 down markets. Okay, that's 57 down months. We outperformed in 86% or 49 of the 57 down months, and the excess return was 11.9%. Okay, so again, I'm going to ask the question that I've been asked over the last couple of weeks between 7 and 10 times. What are we doing to prepare for a downturn? And the answer is, what do we need to do to prepare for a downturn? We're always prepared for a downturn. This down market excess return is almost 12% in core. When you add your 30% macro tilt, you're still outperforming in 43 of the 57 down months with a 75% win rate, and your excess return is still 8.66%. Okay? So when we start thinking about returns for the ECP in core, remember this left table is core, the right table is core with a 30% macro tilt. And remember that for 2021, back in March, I changed the tilt recommendations from 25% to 30%, okay, for all portfolios. So we raised it, and we do that from a top-down perspective to basically bring the ECP core portfolios. And when I say core portfolios, that's the core 75, that's the core Admiral 30, and the core dividend 25. We do that to bring technology, information technology and communication services to the equal weight of the S&P 500. And we do it with those top 6 names that represent roughly 25% of the S&P 500 and have delivered the bulk of the alpha for the S&P 500. So it's very much a top-down strategy, those 6 macro tilt names. And what we're doing is we're managing to this upmarket annual return. Okay, so let's talk about this. Again, this is for the core 75 stock portfolio. You've got a beta of 0.77, right? And if you're running the Admiral strategy, which is the Admiral 30, your beta is even lower than that, and your Sharpe ratio is even better. But what I want you to see here is that your return per unit of risk just in core just absolutely blows away the S&P 500. You're getting 1.05% per unit of risk versus 0.68. And all we're doing is basically taking the return and adjusting it by risk or standard deviations. And you can see that your return per unit of risk is that much higher. And if you look at this with a 30% long-term macro tilt, you're almost 2 times. The Admiral portfolio is actually over 2 times with a 30% macro tilt. So for each unit of risk you're taking on, you're generating in the Admiral portfolio in excess of 2 times the return. In the core 75, you're just shy of 2 times the return. Your value at risk is less. Your max drawdown, even with a 30% macro tilt, is substantially less, and your annual turnover remains very low. So are we afraid of downturns? And the answer is no. That's what this portfolio is built for. And the idea is you sleep at night, your clients sleep at night, and you don't have to worry about all this trade timing. We do have strategies that I work with individual advisors on that allow you to do tactical sleeves and expose yourself to more of the energy, the bank names, and those are things that we handle on a one-by-one basis. If you've got questions about that, you can reach out to me directly. But again, what we're doing by adding that 30% macro tilt is we're managing this negative excess return in up markets. So we had 123 up markets out of the prior 180 months, and the average excess return was negative 6.33. So we're very well protected on the downside, and we use the 6 macro tilt names to raise the portfolio beta up to about 0.89. And that, because that weight in information technology and communication services then comes all the way up to equal the S&P 500, it raises our beta as well. Now we bring the upmarket returns positive, okay? And you can see that here, 123 months now goes to positive 4.25. So you've still got a winning strategy in core. right? Because over the prior 180 months, the excess return's been almost 3%. But when you use it with the long-term macro tilts, you can get excess return of 7% over the prior 180 months. These are actual returns. And obviously, if you want to try to actively manage this a little bit more, we can work together on a one-on-one basis to apply what I call more cyclical or economic cycle sensitive tactical tilt sleeve. These are going to be your energy names, your commodity names, precious metals, and financials, real estate, those types of things, even utilities. Okay. I want to remind everybody that you can check out the ECP Family YouTube channel. It's available for you. You can watch any of these videos at any point. There's 5 of them, and I update these once a year. These are excellent, excellent webinars. And I've done how it was basically created. I've done a special webinar for each of the core portfolios, the core 75, the Admiral 30, and the dividend portfolio. And then I did a special webinar on the tilts that talks about all of the different economic cycle strategies. There's only like 3 of them that we have to worry about, and you've got a long time to make the transition in between. So it's very, very easy to manage, and we're here to help you. Okay. So again, I've re-updated. You can see the end date here through about 10/4, 10/5. One of these is an index, one of them is a composite, so they're up. The end dates are a little bit different. The composite has to basically use prior day's close, which is why this is 1 day off. But we're not looking at the returns per se. The purpose of this chart is just to show that even if you consider the lost decade and the threat of stagflation, all of that, the earnings certain family of portfolios just keeps charging through the performance. Whereas the S&P 500, you can see the index SPAL. That's our S&P 500 index. You can see that, we go through and we give back, 5, 6 years, if not even a full decade here in the Great Recession worth of returns. In the case of how long it actually took to get that return back for the S&P 500 was in excess of 5 years. And you can see that for the earnings certain portfolio, the core 75, even the Admiral dividends, they all look very similar. None of this matters. It just continues to deliver because we deliver that earnings stability through these recessions, and it protects you on the downside. And you can see that we only had about a 2-year and maybe 2-month period where it took to recover. So we rebound faster, harder out of recessions, and we deliver more alpha that way as well. So again, just why does this work? I'm just going to run through this just so you can get an idea of how you'd present this to your clients. And this slide deck is available for you. Ford Motor Company, these are names that you just don't sit on as a long-term investor. Had you bought this company after the Great Recession, 2010, 2013, 14, even though Ford's done really well, you're still underwater. Same thing with Schlumberger. This is just a sector in decline. You can see the variability in these earnings. These are companies that you try to time. You do not hold these long-term. You don't want exposure to that earnings variability in core, okay? So this is why it works. We like companies like Church & Dwight, right? I always joke that Arm & Hammer baking soda and Trojan condoms just don't go out of style. And you can see that, right? That's what Church & Dwight delivers. And you can see these earnings just ripping right through recessions. You can see the price response that follows. We don't have this Ford Motor Company, Schlumberger cyclicality. Same thing with McCormick. Everybody's got to eat. Everyone knows the story with McCormick. This is the spice company, and look at the earnings stability. When we start talking about that ROA, that ability to compound return on total assets, again, I'm going to now speak to total assets as kind of a proxy for invested capital. I think that's probably a better way to explain it to everyone. To keep in mind that total assets equals liabilities plus capital, so we can use that as a proxy for invested capital. And you can see that the average earnings certain stock, in terms of the 75 stock portfolio, has the ability to compound this return on their asset base. It's almost 2 times the S&P 500. And you can see why, right? Companies like Church & Dwight and JP Morgan, I mean, there's just no comparison here. Church & Dwight's sitting at about a 10%. JP Morgan's about 137. McCormick versus Ford, a little bit closer, but keep in mind this is cyclical. McCormick has been literally sitting at this level for years. One of the comparisons I love to make is that, you hear every day about Caterpillar. I would much prefer to own Fastenal. I don't have to worry about timing the trade with Fastenal. Fastenal is just an incredible industrial company that has just rock solid stability in their ability to compound return on assets. Caterpillar just doesn't have it, and Caterpillar's got a lot of exposure to emerging markets, and we've got a dollar that's strengthening right now. A lot of headwinds coming for emerging markets related to that dollar strength, right? When you get the dollar that strengthens, you end up getting these capital vacuums that take place not only in Europe, but across emerging markets as investors start bringing capital from those markets into the United States to put money into our rising treasury yields. And so that's a problem. And then think about the perspective of emerging market companies themselves that require debt financing. Most do. Especially those that are buying Caterpillar equipment, right? They're borrowing in U.S. dollars, and when our interest rates go up in anticipation of inflation, that raises the borrowing cost for emerging markets. So just, as far as Caterpillar is concerned, I'd much prefer to own Fastenal longer term. Caterpillar is a cyclical name. Fastenal is a long-term growth stock, and you can see the difference here on the return on assets. Okay. Same thing with the ability to compound return on common equity. Earnings certain portfolio always above the S&P 500. S&P 500 is accelerating a lot due to the cyclical rebound, but again, it is very cyclical in nature. The earnings certain portfolio is still beating it by about 4%. You can see Expeditors down here, ROE versus Schlumberger. Expeditors is a company that I mentioned earlier, probably the best of breed global transportation logistics company. I use them in conjunction with C.H. Robinson in the earnings certain family. And you can see that is basically outperforming Schlumberger on an ROE basis, almost 4x. Okay. When I toggle to this next screen, I'm going to go back. I want everybody to keep their eyes on Expediter and Schlumberger right here, and keep an eye on the difference between ROE and ROC. Effectively, what we're doing when we're toggling between ROE and ROC is we're just incorporating the debt structure into that. Now, Expeditors doesn't have any debt, and exactly why I use them as an example on this screen. And when I toggle to the next view, you'll see that it stays at 35.9, but Schlumberger gets cut in half because half of their capital structure is roughly debt. So I'm going to go previous 9.96. You can see I can go next. Return on capital drops to 4.41. Expediter is still sitting at 35. So now we're looking at almost 8 or 9 times more efficient at compounding return on capital, which is just spectacular, right? I mean, Schlumberger has it, or Schlumberger doesn't have it. Expeditors has it. And again, we get back to that free cash flow, return on invested capital. Look, we already talked about this. I'm not gonna dive into it any further, but this is going the right direction. This is going the wrong direction. And you can just see it here. I mean, look at ADP. I mean, these guys just continue to compound free cash flow, and these guys are masters. So are Paychex. There's a lot of these companies in the earnings certain portfolio that do this. ExxonMobil's on the rebound. They haven't had quite the need for the capital expenditures yet. They're trying to figure out what's going on with legislation. They haven't reinvested as much in their business, and that's definitely helped their free cash flow return on investment. But it's hitting a cyclical peak at about 7.07. We haven't seen these levels since 2014, 17, and 18. So that's still roughly 5 times better ADP than Exxon free cash flow return on investment. So the idea is, right now, you want to explain to your clients that you can have all the benefits of the earnings certain family methodology, if you will, and safety and downside protection and everything else, the superior return per unit of risk. And it's actually trading at a 2% discount right now to the 20-year median of the S&P 500. So you can see right here, I've got the 20-year price and earnings chart on the screen, and the median is 1.18. So the median calls for an 18% premium. That's what that means. When you see a median of 1.18 on the ECP versus the S&P, that's an 18% premium. We're only trading at a 16% premium. The low is a 1% premium. So we're within that range. It's literally a 2% discount on the core 75, okay? The Admiral portfolio, one of our most popular portfolios, I'd say that probably 50% of advisors, we've got probably over 350 advisors now using the strategy. Probably half of them are Admiral portfolio strategy users. And you can see that currently a 9% premium, the median is a 14% premium. I have this says at a 5% discount. So if you just take 9 minus 14 is roughly a 5% discount. But you can see I have the trend line plotted here over the past 20 years, and this is where we're at. That's the 30 stock Admiral. The 25 stock core dividend aristocrat portfolio, that's trading at about a 2% premium right now, and it's a superior strategy relative to the Noble ETF that a lot of advisors like to use. And we can work one-on-one to embellish, if you will, or enhance the yield on this. There's a lot of different ways that you can tweak the dividend portfolio and the earnings certain family, but it's trading at about a 2% premium, so it's roughly at parity. I did want to mention, if I go back to, let me see, how do I go back to the beginning? Maybe if I just end the show and go back. That if you request the slide deck, I will fix all of these slides. I apologize. I didn't even recognize that they were only 15 years. I will run these out to 20. So anybody that's requesting this deck to get the latest update from me, just go ahead and send an email and we'll get it out. I am constantly reviewing not only the equity select lists, but the earnings certain family in its entirety. So anybody has any questions, more than happy to answer them. Just reach out to us, and we'll go ahead and get any of those questions answered. So that's about all I've got for today. I hope that everyone has found this discussion useful. I literally tried to make it more of an open forum discussion about some of the comments and questions and thoughts that I've received in my discussions over the past probably 2 to 3 weeks now. I said, 7 to 10 advisors had reached out to me about trading rules and how to try to kind of game the trading within the earnings certain family, and I've kind of advised against that. It's really hard to beat the strategy in core. Those names work well for a reason. They've been working well for in excess of 25 years for a reason. So if anybody wants to discuss that or anything else related to changes or no changes, I should say, for Q3 2021, more than happy to discuss. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or the Zacks Research System, or if you're just looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and zrs@zacks.com. Thank you for watching, and I'll talk to you all next week.